All right. I will definitely be adding people as they come in. Cody, thanks so much for having us. We're so excited to be doing a second webinar with Planoly all about taxes.
Yeah, thank you guys so much. We're excited to be here. And thank you to everyone for coming. We'll start with a quick little intro. If you aren't familiar with Planoly, Planoly launched in 2016 as the first visual Instagram planner, and as social media and the creator industry kind of have evolved, so have we. So our social planner is now a multi-channel scheduling tool, and we also just recently launched our creator store, which is an online storefront where you can sell digital products, accept payments, and connect with your customers all from the link in your bio. So we're really excited about that. If you have any questions about Planoly or Creator Store, please don't hesitate to reach out. But otherwise, a big thank you to Cookie Finance for hosting this with us. We're so excited to dive in, and I'll pass it over to you guys to get started.
Awesome. Thank you so much, Cody. I really appreciate it. Um, Thank you all for joining us. I know taxes are never the most enjoyable thing to talk about, but hopefully we can uh, give you all a little bit of peace of mind, kind of take some of the stress off of you. This is, we have I'll call it a formal presentation that we'll be doing. But please, along the way, if you want to drop a question in the chat, please go ahead and drop a question in the chat. If you do feel comfortable, you can unmute yourself and just stop me. And Cody, same with you. Like, feel free to stop me at any point and be like, "Oh, hey, Nate. Like, this is a question I get all the time. Can you talk about this?" So I'll kind of take pauses throughout just so everyone will have time to ask any questions. And yeah, with that, I'll kind of get started. Let me just share my screen real quick for you all. It's always helpful to kind of know where everyone's calling in from, just because taxes state by state are a little bit different. I can, curate a few of these questions to that. If you want to put in the chat where you're at, that'd be great. We can give kind of talk about some of the different. Ooh, nice. Kansas and Wisconsin, New York, New York. Uh, Perfect. I'm so, New York City. That's like tax heaven there. I'm sure you love all of that. All right, Katie, can you see my screen? Thumbs up.
Yes,
Perfect.
you are good to go.
Okay, awesome. Well, thank you all for coming. Just so you know who we are Cookie Finance. We are an accounting platform specifically for content creators. I started this almost exactly 2 years ago. And the whole point of Cookie Finance is to support creators with your taxes and bookkeeping and quarterly taxes, and really give you that financial peace of mind when it comes to taxes. I know it can be really confusing, really scary, especially if you're starting to make money or if you're starting to make a lot more money than you have in the past. This can be a really scary topic. So that's what we're here for, is to help creators like you. I've been a CPA for over 12 years. Uh, and like I said, started Cookie Finance a couple years ago and absolutely love the space. We love creators. Our whole team is so creator focused. That's all we work with. We know the industry inside and out. So please feel free to ask any and all questions, no matter how nuanced they are. And if you don't feel comfortable asking a question on the webinar, Katie, a little bit later, will drop a link where you can set up a free consultation with us. But we should be able to answer probably the majority of your questions on here. So how we'll kind of go about this webinar, we're going to hit it in 3 different steps. The first part, we're going to talk about just what are the basics, the hygiene items that you need to be taking care of right now to set yourself up really nicely for taxes and bookkeeping and everything for 2025. It's building the foundation. So we're going to talk about that. We're then going to move into the taxes that you owe as a content creator, kind of some good rules of thumb of how much you should be expecting to pay in taxes, and a little bit demystifying all the taxes that you're hearing about and seeing and so on. And then the final part will be how to then minimize those taxes. So we're going to talk about the taxes you do owe, and then we're going to talk about how to minimize those taxes by finding every single little tiny deduction on your tax return. And that is where you're going to save all your money in taxes, is by finding those deductions. I know as a creator it can be really difficult because your business and personal life are basically one and the same. but we're going to help you navigate that and give you some really good rules of thumb and some resources to help you navigate that. So let's start by talking about getting the foundation right for your business. A question that we get a lot, this is probably one of like our top 3 questions we get from people is, should I form an LLC? And the answer is almost always yes. And our kind of thought is, if you are taking content creation seriously, which I imagine if you're here on this webinar, if you're working with Planoly, it's because you are taking content creation seriously. If you're taking it seriously, even if it's a side thing that you're trying to build into a more full-time thing, or you are full-time, it makes sense to get an LLC. And the reason why we say that is, well, actually, I'll get to that in a second. The next big thing, if you're getting an LLC, is, do I really need a separate bank account for my business? And the answer is 100% yes. Even if you don't have an LLC, you're just starting this out, getting a separate bank account is going to be really important. We'll talk more about that in a second. And finally, tracking your financials is just going to be one of the most important things to getting that foundation set right. So I'm going to go through each of these in a little bit more detail. And let's talk about why you should form an LLC. If you're in Tennessee, which I didn't see anyone say they're in Tennessee. If you're in Tennessee, it might not make sense to form an LLC. If any of you are, put that in the chat. I'll talk a little bit more about that. But why we do an LLC? The first big one is protecting your personal assets. So you are a public figure. Your name is out there. You have, tens of thousands or hundreds of thousands of followers, and you're becoming more and more of a public figure. The likelihood that you get sued just continues to increase over time. And if you don't have an LLC and you just operate as a sole proprietor or under a DBA, and you were to get sued and someone won that lawsuit, basically they can go after any of your personal assets to fulfill that judgment. They can go after your house, your car, your bank account. They can garnish wages. They can, sell your kid. No, just kidding. They're not going to take your kids. But if you want them to, they can. But they go after all of your personal things, right? Whereas if you have an LLC, then the most they can go after are the assets of your business. And for creators, your assets are very, very tiny that you have in your business, which is the beauty of this industry, right? You don't have expensive machinery and equipment and inventory and real estate, all of these things. It's a very minimal amount of assets you have. So that's the first big one, is you're protecting those personal assets. And that's a big one. The next big one is legitimacy. One of the biggest risks from a tax perspective that creators face is the IRS considering what you're doing to be a hobby. Now, if the IRS says, hey, Cody, what you're doing is great, but what you're doing is a hobby, what that means is you get 0 deductions. And you have to pay taxes on 100% of the income you're making from your content. That is a huge blow. That could cost you thousands and thousands and thousands of dollars by having it that way. Now, you might say, well, what's the difference between a hobby and a business? Like, why would the IRS consider that? Well, the IRS has like 9 different criteria they look at to consider it, whether it's a hobby or a business. And why it's a hobby, you don't have an LLC set up. You don't have an EIN. You don't have a separate bank account. You're not tracking your financials. You're not doing quarterly taxes. You're not treating it like a real business. And that's a big mistake that we see time and time again with creators, is they don't treat what they're doing like a business. But all of you have a real business. You are all entrepreneurs. You're business owners. And you need to treat yourself like that, because you want the IRS to treat you like that as well. So that's a really big one, is getting that legitimacy in the eyes of the IRS. So you are treated like a business, and get those deductions that we're going to talk about in a little bit. And the final one is just protecting your identity. So with an LLC and EIN, I'm sure all of you have filled out lots and lots of W-9s with brands and platforms and so on. Well, when you have an LLC and EIN, moving forward, you don't have to put your name and social security number anymore. You can just do your LLC name and EIN. And what that does is it protects you from sharing your social security to all these different places, right? We have this one client who was a UGC creator, and she worked with dozens of these smaller sized businesses, filled out all these W-9s. And unfortunately, just some of these companies, they don't have great security. One of them got hacked. They got her social. It was then sold, and it was a huge process of like redoing all of her bank accounts and credit cards and everything else. So it's protection to you, right? Like you want to protect your name, your social security number, all of it. So that's a big thing with the LLC. Now it looks like, and I hope I'm pronouncing this right, Kiara or Kira is in Tennessee. Tennessee is a little bit different. Tennessee doesn't have any state income taxes, but Tennessee does have taxes on businesses. Call it 6.5%. And that includes LLC. So if you're an LLC in Tennessee, you might get taxed an additional 6.5% on your net income from your business. But you aren't charged that tax when you are just a sole proprietor or have a DBA. So for Tennessee, if you're making less than 100,000 or so, it probably makes sense to not have an LLC. You then do have those other risks. So you just kind of have to like weigh those pros and cons of you take on those risks, but then you don't pay the tax, or would you rather pay the tax and have those risks mitigated? So, but feel free to set up a time and we can chat a little bit more about that. Okay, separate bank account. This is a huge one. If you don't have a separate bank account, welcome to like 95% of all of your friends who are also content creators. It's extremely rare that we run into a creator. We've worked with hundreds of creators. Most of them don't have a separate bank account. So don't feel bad if you don't have these things. Like most people don't, right? This is not to shame anyone. But a separate bank account is essential. It doesn't have to be necessarily a business banking account, although we prefer that, but it can just be a separate personal checking account where you have all of your income going into that account from your content creation and all of your expenses coming out of that account. If you like to use a credit card, then having like a separate credit card just for the business. It doesn't have to be a business credit card. It can be a personal credit card that you just use for content. The idea is you have your business over here and your personal over here, and you keep it very, very clean. It saves you a lot of time. I'm sure a lot of you right now are like trying to go back through thousands of transactions from this last year, trying to pull out all those things for your accountant. It's a huge pain in the butt to have to go back, find all the different payouts and be like, oh man, was this Chick-fil-A? Like, was that business or personal? I can't remember. You know what? I'm going to err on the side. I'm just saying it was personal and not taking that deduction. So having it all completely separated, it's going to make tracking a whole lot easier. You're not going to miss those deductions that we're going to talk about in a little bit. It's going to make things a lot easier for taxes. And what's going to add that legitimacy with the IRS with a separate bank account, that you're treating it like a real business. So these are the bank accounts that we really like. We typically recommend going with an established bank or brand. Chase, Wells Fargo, Capital One, these are really, really good brands. If you want like an online only bank, Mercury is a really great option as well. Most banks are pretty decent. The only ones we say to kind of be careful about, and not in a bad way, like credit unions are always a little bit tricky. Credit unions are usually a little bit dated in terms of technology. They don't really play well with all the different like QuickBooks or Xero or Gusto, things like that. We just have quite a bit of problem with clients who are part of like maybe Federal Credit Union or any other credit unions. So we typically recommend kind of one of these banks. Okay. The final thing that I talk about for the hygiene until we get to the taxes is keeping track of your financials. This is like I mean, I love this type of stuff, but most people aren't weird accounting nerds like me. But most people, they hate doing the tracking of their financials. And I get that, right? It's super tedious, but it's really, really valuable to be able to see these numbers. We recommend tracking your income and expenses on a monthly basis. Um, don't sign up for QuickBooks or Xero if you aren't familiar with accounting and bookkeeping. You can use like kind of screw things up more than it helps if you don't know what you're doing. If you're making less than 60, 70,000 a year, you can probably kind of do like a DIY. Download this tracker. It's totally free. You can put in all your income, expenses, categorize them. It's nothing too fancy, but it's a way just to start getting that hygiene of tracking your income and expenses on a regular basis. Once again, the benefits of this. A big one is saving you time at the end of the year when you're doing your taxes. It's all put together, it's all clean, so you can do your taxes, make it nice and easy. You can start to see trends. I know one big question a lot of people have, in fact, we're helping a client right now go through this, is they're like, I don't even know if I am making enough money to go full time. That's a question we get a lot. Like, am I making enough money to go full time? And they don't know because they're not tracking all their income and expenses. So they don't know how much are they really making from their business to make that decision of go, no go, of go full time or not go full time. So you can start to see trends. There's lots of good things that go with tracking your income and expenses. So definitely check that out. Okay, let me pause here before I jump into taxes. Katie, was there anything I missed in the chat in terms of questions?
One common question came through about forming an LLC in a state without state income taxes in order to pay less. True or false?
Oh, I hate this. This needs to be probably one of our TikTok reacts, Katie. I hope it is.
For sure.
This is such a terrible piece of advice that's out there on TikTok that, save taxes by, set up your LLC in Wyoming. That seems like be like the really popular one. The answer is that does not save you any amount of taxes. In fact, it can actually be more of a headache and burden to you by setting up your LLC in a different state. If you're in California, for instance, that's where we're at right now, is in California, and they have tons of taxes here, and you say, hey, I want to save taxes by setting up in Wyoming that has no state income taxes. That's just not how it works. How it works with a business, LLC, sole proprietor, what have you, is all of that income and expenses ultimately show up on your personal tax return. So you take all your business income, all your business expenses, that all shows up on your personal tax return. And then you pay taxes on the state that you are living in, not where the business is located. Your LLC or your sole proprietor does not pay taxes. So I would strongly recommend you don't set up an LLC in a separate state that you're living in. You are not going to save any amount of taxes at all. All right. Any other questions I missed, Katie?
There was a question about taxes in regards to digital courses and products, but I'm assuming you can get into that in this section. And then the big question about paying taxes on gifts came up as well, which I know we'll address later in the presentation too.
Yep, absolutely. Perfect. Yep. And if I forget, please make sure you get me.
Definitely.
Okay. So this is the first big thing. Once again, another huge misconception. Like in general, if you hear tax advice on TikTok, you might want to like just do a little bit of research because there is a lot of really, really bad advice out there. And this is something that we see all the time. It's, hey, if you make less than 5,000, if you make less than $600 from content creation, then you don't need to report that income. And that is 100% false. You need to report every single dollar you make from content creation on your taxes. Even if you made $5 and that was it, you still need to report that on your tax return. There is no minimum that the IRS has. They want a piece of every single dollar you're earning. They're trying to get their fingers in every single dollar. So every single dollar you earn, you need to report on your tax return. Okay. Now, with that, right now, a lot of you are probably in tax form, hell right now with like 1099s and 1098s and W-2s and all these different forms coming in. And it can feel very overwhelming. especially if you've worked with a lot of platforms and brands. You might have a big pile of 1099s piling up and don't really know what to do with all of these. So let me focus on 1099s. I'm not going to worry about these other forms right now, mainly because 1099s are kind of like the big thing that you're dealing with right now. So in general, a company or brand or platform, if you earn more than $600 from them, they are supposed to, that's the key word, supposed to send you a 1099 that lays out exactly how much they paid you last year. They take that same 1099 and they send a copy to the IRS. And then when you do your tax return, the IRS compares what was sent to them versus what's on your tax return and make sure that it lines up. They just want to make sure that you're not under-reporting your income. Okay, so that threshold is $600. Now, not all companies and brands send out 1099s. Some of them send them out late. They were supposed to send them out by January 31st. I know TikTok just sent theirs out like last week, so they were just a few weeks late. And sometimes they don't send them out to creators at all. If you're working with a smaller company, you might not get any 1099, even though you were above the $600 threshold. Don't worry about chasing down those 1099s. That's more like the company's deal if they don't send it to you. And regardless whether you get a 1099 or you don't, you still need to report that income. So if you did a $5,000 work for a company, they never sent you 1099, you still have to report that $5,000 on your tax return. Just not worth your time to like go hound these companies, be like, hey, you never sent me a 1099. They'll probably just ignore you and be like, go pound sand. It's not that big of a deal. Now, here's where it is a big deal. And this is where it goes back to tracking your financials. You do want to compare what was submitted on that 1099 to your own records, because I have seen this so much that a company will put the wrong amount on the 1099. So the 1099 they sent you might show 15,000, and you're like, whoa, whoa, whoa. Mine only says, like, my records show 10,000. You need to go talk to that company to get that amended and fixed. That is essential. Otherwise, the IRS is going to assume you actually got paid 15 and you're going to get, excuse me, taxed on an additional $5,000. So please make sure you are checking that against your own records. Okay. That's kind of it on 1099s. Like I said, there's a lot of other tax forms. Don't really have the time to go through all of these. But let's talk about the actual taxes that you are going to owe as a creator. So everyone knows like what you are actually paying taxes on. If you made income of $100,000 and you are able to find $40,000 of legitimate business deductions, business expenses, that means your net was $60,000. You are paying taxes on that net number. You do not pay taxes on the 100,000. You are paying taxes on that 60,000. So that's why in a second, when we get to deductions, that is why you can save a lot of money by finding those good deductions, because you pay taxes on that net number. So that is how we are going to reduce our tax bill. Okay, so in this example, you have $60,000 of net income from your business. What taxes do you owe? Well, the first big one is going to be federal income taxes. You probably are all aware of this. It can be anywhere from like 10 to 35, 37%, depending on your tax bracket. How your tax bracket is determined, they take the income from your business plus the income from your W-2 job. They take the income from your spouse's W-2, they put it all together and they say, you made this much, that puts you in this tax bracket. So you'll be paying taxes on that. And once again, range kind of anywhere from 10 to 35%. That's the first big tax. The next one is state income taxes. Like I said before, all of the income and expenses flow from the business to your personal tax return, and then you pay taxes individually for the business. Now, if you're in a state like Tennessee or Florida or Texas, you have no state income taxes. Congratulations. If you're in a place like California or New York, I'm really sorry. You have like the highest taxes in the country, and it can be anywhere from like 8, 10, 12% that you have in those taxes as well. So make sure that you plan for the state income taxes. A lot of people plan for federal, but then they kind of forget to plan for state taxes as well. Okay, then the final one. This is like the doozy that really throws people through a loop. They're not ready for. It is a huge surprise to them, and that's self-employment taxes. Self-employment taxes are Social Security and Medicare, and it adds up to 15.3% on top of your federal taxes and your state income taxes. Now, self-employment taxes, if you've had a W-2 job in the past, you've been paying those your whole life, like the whole time you had a W-2 job. Ever since I was 15 years old working at a dry cleaner, right? Like I've been paying these Social Security and Medicare. So what that is part of it is Social Security, part of Medicare. You add that together, 7.65% of everything you make. What most people don't realize, and you'll see that on your paycheck, you'll see Social Security, Medicare taken out of every paycheck. It's submitted to the Social Security Administration on your behalf. And then one day when you retire, hopefully there's money in there and then, take on Social Security benefits. Now, what most people don't realize is that your employer is also paying 7.65% in taxes as well. So you pay 7.65% as the employee, and they pay 7.65% as the employer. You combine that together, that's 15.3%. Well, as a lovely creator, you are self-employed. That means you are both the employee and the employer, which means you pay both halves of that. And that's how you get to that 15.3% we were talking about right here. Now, one question we get is, well, I have a W-2 job. It's like I'm paying Social Security, Medicare through my W-2 job. Does that count? And the answer is no. Like this is above and beyond. You have to pay Social Security, Medicare on these earnings as well. So this tax right here, self-employment tax, a lot of times, especially if you're in a tax bracket below, call it $150,000 or $200,000 a year, a lot of times the self-employment taxes can be just as big or larger than your actual federal income taxes. So what we kind of tell our clients and just all creators is the best practice is set aside 25% of everything you make. That's gross. So if you made $100,000 last year, take 25% of that, set it aside for taxes. Put it in a separate savings account. Do not touch it. It is not yours. It is the IRS's money. It's the state's money. Don't treat it like your own. That's the trap we see entrepreneurs falling into. They're like, oh, well, I'll make up for it later down the road. Like I'm expecting this big payout later. And then tax time comes due and they're like, oh, crap. I don't have money in my account to actually make that payment. Then you need to go on a payment plan. And then you're on the back foot when you're doing taxes in the future. So 25% of everything you make, set it aside in a separate savings account. And it should be a good rule of thumb of what you can expect to pay in taxes between federal taxes, state taxes, and self-employment taxes. It's kind of a good rule of thumb. It might be a little bit less, might be a little bit more, but it should at least cover a big portion of what you owe. Now, speaking of money that you owe, and then I'll take a quick break and we can answer some questions. Quarterly payments. This is one of the best hygiene practices you can get into is making quarterly estimated taxes. I'll go back to the W-2 job example. When you're at a W-2 job, they are automatically withholding federal taxes and state taxes and Social Security on your behalf. They submit it for you. And at the end of the year, you do a tax return to kind of true everything up. So you're probably used to that. Well, as self-employed, as an entrepreneur, no one is doing that for you. no one is taking money out and giving it to the IRS or state or so on. So it is fully your responsibility, unfortunately, to make those payments to the IRS. And the question is, well, is it mandatory? Do I have to make these payments? The answer is no. It's not mandatory. You don't have to make these quarterly payments. Now, you have to pay them eventually, right? Like at the end of the year, you have to make those payments. And the IRS will tell you, they'll say, hey, Cody, that's perfectly fine. Like, don't worry. Like, you don't have to make those quarterly payments. But if you don't, we're going to charge you 8% interest on that amount you owe, plus penalties and fines on top of that. But it's chill, Cody. Like, don't worry about it. Like, you don't need to make those quarterly payments. That interest and penalties and fines can add up to thousands of dollars. And it's sneaky. Some of you might be like, oh, why? I've never had to pay that before. You probably have. It's just like kind of buried within your tax return. It's automatically calculated on your tax return. You'll see at the very bottom, there's a line for penalties and interest. It's automatically calculated when the tax return is prepared. It's down there. You don't get a separate bill. It's all part of the same tax return. But if you haven't never done quarterlies in the past, you've probably been paying hundreds, if not thousands of dollars in fines and penalties. You might not have even known about it. So make those quarterly payments. It's a good hygiene practice. You make sure that you constantly are staying on top of taxes. You're not hit at the end of the year with tens of thousands of dollars worth of tax bills. Okay, I've talked a lot. Katie, what did I miss here?
You pretty much touched on answering this question, but someone asked, does the self-employment tax still need to be paid if you aren't pulling a paycheck from your business?
Yep, 100%.
Yeah. So different question. If you could just talk about taxes whenever it comes to digital products and courses, and if it's any different as far as that income stream goes.
Yeah. Digital products, like online courses, you don't need to pay. You're probably talking about sales tax. You don't have to pay sales taxes on digital products like an online course. So if you have an online course, don't worry about sales taxes. You still have to pay normal taxes, federal, state, self-employment taxes, but you don't need to worry about sales tax. Now, those laws are always changing. That is state by state by state. So every state is different, and they are literally changing those all the time. Make sure you pay attention. Like if you're on a platform like Kajabi or one of those platforms, they should already be automatically like calculating those things for you. So just look at, once again, in general, you don't need to pay taxes, but it is variable based on the state, and those laws are changing all the time. So it kind of stinks to have to pay attention to that. But if you are on a platform, it should automatically be, letting you know exactly how much you should be charging for taxes. But for the most part, you don't need to worry about that.
It looks like a follow-up to that one was about Wisconsin specifically. I don't know if you want to address that or if you know off the top of your head.
Let's see. I thought in Wisconsin you did, though. I have it selected in Samcart and Kajabi, but they aren't taking anything out of Wisconsin. Yeah, I'll look into that. If you want to hit me up, Leslie, afterwards, there's my email, my personal email. Feel free to hit me up afterwards. I can take a look at that. And we can look into that. We're connected. We're connected pretty well with Kajabi, and we can see like what's going on over there as well. Okay. What else did I miss, Katie?
Yes. Is grant money treated any differently as far as taxes go?
Yes. Yeah. There's a whole bunch of different classifications of different income, grants, prize money, things like that. It depends on the context of how it's paid out to a business or so on. It's a little more nuanced kind of for this call. But yeah, like prize money, grant money, things like that, it is taxed differently. And depending on how it's paid out and everything else, it's taxed differently as well. So we can, if you want to book a call, we can kind of chat a little bit more in depth about like that question in particular.
A couple of questions about this session being recorded. It is, and we'll email it out to everyone probably first thing tomorrow. Also, someone did ask, my accountant files quarterly taxes with $0 reports. With that, am I subject to that 8% interest and penalty?
Yes, you are. I mean, what they might be doing, which is completely wrong, they might tell the IRS like, oh, no, you did not make any money in Q1, Q2, Q3. All of your money was earned in Q4. And if that's the case, then you're right. You would only pay quarterly taxes at the very end. But unless that is the case, if you have been earning money all throughout the year, you have to pay interest and penalties on that. So make those quarterly payments throughout. Unless it's like a very, very, very rare situation where all of your money is only earned in like December, you're going to have to pay penalties interest for that entire year.
And pretty much caught up with the exception of the gifted products question, which I know we'll get to.
Yes. Yeah, I might say that for the very end. It's a little bit more of a nuanced question. So yeah, we'll talk about deductions and then we'll get to the gifted products. I know that's a very big, important question that we'll go through. And thank you all for like participating. It's always nice when there's real questions that we can answer for you. It's always difficult when it's just pure silence and we can't help you. We're here to help you. Like we really want to cater this to you specifically. Make sure that you're getting good advice. Okay, before we start, Katie will also put this in the link. Download this our cheat sheet, deduction cheat sheet. It's a 2-page. It's pretty in-depth. A lot of people have found it pretty useful as they're trying to navigate deductions of what is and isn't deductible. How do you guys feel about it? Because the reality is, before we kind of go headlong into deductions, is that deductions are extremely great. Everything we're going to talk about today, for the most part, is not a like 100% guaranteed you can deduct this. Now, here's what I mean by that. And that's true for every business. The last time the tax code was completely overhauled was in 1986, year I was born. 1986 was the last year, so about 39 years ago, it was overhauled. And it's been touched since then. Like they've made updates and like different law changes, but no major overhaul since 1986. Now, when they do these major overhauls, basically they have to make the tax code as broad and general as possible because it has to apply to millions of businesses across hundreds of sectors and thousands of niches. And they can't have it be like, okay, we're gonna have a whole set of tax code just for YouTube content creators within the gaming space. Okay, now we're gonna have a whole set of tax code for Instagram creators within the lifestyle space. Like they can't do that. So it has to be very broad and general. They give guidelines, and then it's up to you and your accountant to navigate that, to use those guidelines and apply it to your business. Now, that can be really frustrating and sometimes actually scary for people because it's like, well, then how do I know what I'm doing is right? So everything we're going to talk about today, these are things that we're using those general guidelines and applying it to creators specifically. These are things, once again, we work with hundreds of creators that our creators aren't getting audited. In fact, this is not a guarantee at all, but none of our creators have been audited because these aren't pushing the envelope. These are very legitimate things that we'd feel 100% comfortable saying like this is deductible. So just understand that like with deductions that there is no black and white. It's everyone navigating it based on their interpretation of it. Okay, so I'm going to be using the word deduction, write-off, expense interchangeably throughout this. It's all the same thing. A deduction is just a legitimate business expense. So if I say deduction, write-off, expense, I can't remember, I just said expense. They're all the same thing. It's just a legitimate business expense that lowers that taxable income so you pay less in taxes. Like I said, tax code is very, very gray. And so we're going to help you try to navigate that. And in order to help you navigate it, it's really useful to have um, like a North Star, a guidepost that you can use of like, is this deductible or not? Because the truth is, and I haven't looked at any of your content, um, the deductions for each of you is going to be unique to like you personally. For instance, Katie might be a gaming content creator, which spoiler, she actually is. Katie might be a gaming content creator. And so her deductions are going to be look very different than Cody. I don't know if Cody, if you're like a side creator or not, but then Cody, who might be like a home decor content creator, the deductions are going to be very different. So we want to use a guidepost, a North Star, as you are navigating taxes to figure out like what is deductible for me. And how we want you to think about it is to think about your phone. Okay. Your phone, let's say Apple spent hundreds of millions of dollars developing this phone. They spent hundreds of millions of dollars on research, development, materials, packaging, shipping, marketing. All of those expenses went into making your phone. All of those are legitimate business expenses. Those were the costs they had to spend to make a product to then sell to you for a profit. So all of those expenses that went into making this product that they sell to you, in accounting speak, is called the cost of goods sold, or COGS, if you want to be like really cool and like know like the secret passwords within like the accounting world. Say COGS in front of like any finance or accounting person, and like give you like a wink and be like, you know it. Cool, that's awesome. So the cost of goods sold is the costs that go into making your product that you're selling. And this is where creators, I think, get caught up, because I think a lot of them don't realize that you are selling a product, and that product is you essentially. You're selling your brand, you're selling your following, you're selling the trust that you gained with your community, you're selling your views. Those are the things that you are selling. It's why brands pay you money, because they want access to that community that you built and that trust you've built. If you're getting AdSense, they're buying the views that people are spending time on your videos. If you're an affiliate marketer, you're getting paid for the people who are clicking on those links because they trust you. They then buy the product and you get paid out for that. So that is what you're selling. And if that's what you're selling, that means any expense that goes into building your brand, building your content, building that trust, building your engagement, building that content, those are going to be the things that are going to be deductible. And that's why it's kind of unique to each of you as a creator. Now, with that, there are some deductions that all of you can be taking and that you should be taking. So the first one is your technology subscriptions. If you use Adobe, Epidemic Sound, if you use any type of software, if you use a scheduling software like Planoly or anything like that, those are going to be deductible. So those expenses, make sure you are deducting. TV services, you have to be very in tune with latest trends. So we feel very comfortable deducting Netflix, HBO, Apple, things like that. It's no different than a company deducting their Wall Street Journal subscription. In order to stay current on the news, for you have to stay current on the trends. Cell phone, internet, obviously, like you would not have a business without your cell phone and internet. So make sure that you are deducting that. If your spouse is part of the plan or whatever, you can always take a portion of it. And even if like you're on your family plan, like your sister's plan or your mom and dad's plan, you pay them each month reimbursement, then you can still write that off as well. That's a question we get a lot. Make sure that you're writing off your equipment. So if you bought a new camera, a computer, lighting, video, sound, backdrops, any of that is going to be deductible. If you have like a home office space, like the desk you have, your chair, if you have like any cool decorations and backdrops, like make sure you're deducting those things as well. Health insurance, if you are paying for health insurance out of pocket, like you don't get it from an employer and your spouse doesn't get it from an employer, but like you are straight up paying for out of pocket, make sure you are paying or deducting that health insurance. Marketing expenses, ads, if you are running ads, I know it's not, a lot of people don't, but quite a few of our clients do run ads, make sure you're deducting those ads. Agency fees, if you work with an agent, and they're taking 15-20%, make sure you're deducting that so you're not paying money on the gross. Professional services, so if the cost to form your LLC, any legal expenses, your accounting fee, the cost to file your tax return, those things are going to be deductible. If hiring contractors, if you're hiring contractors to help you edit videos, or you're hiring like a virtual assistant, things like that, make sure you're deducting those expenses as well. Portion of your home can be deducted as well. If you use a portion of your home as a dedicated office space, you can run off a portion of your rent or mortgage, as well as your utilities, for the portion of your home that is dedicated office space. Now, one question we get a lot is, well, like basically my entire house is my home office. Like I'm shooting all over my house. No, you cannot write off your whole house. You will get audited quicker than anything. So don't do that. But just find something reasonable, right? Like a space that you can reasonably say is a home office space, and don't make it more than 300 square feet. The IRS is pretty chill about the home office deduction. Like it's a very legitimate, normal expense, except when it goes beyond 300 square feet. That's when it starts to raise red flags to the IRS. So even if like you use more than 300 square feet, like keep it below 300 square feet, just like reduce that audit risk. Personal items, if you're camera facing, hair, makeup, nails, those things are going to be deductible. Clothing, if you're buying clothing for a specific shoot or piece of content, that can be deductible. If you're just buying some nice PJs, that's not going to be deductible, but make sure it's actually like part of your content and kind of needed for that. Now, if you're a fashion creator, we have lots of fashion creators. Pretty much all their clothing is deductible because like all of their clothing is then posted and affiliate linked and everything else. So like that's easy. Like if there's affiliate links associated with that clothing, that's easy, 100% deductible. If that's not the case, it's a lot limited to like what you can do for that. All right, travel expenses. If you're traveling for collabs, brand content, conferences, that's easy. That trip is 100% deductible. The flights, Ubers, hotels, meals, all of that. And then if you take a personal trip, personal trips can be deductible as well, so long as you're producing a lot of really good content around that trip. Like not just like posting one picture of you in the Turks and Caicos, like make sure you're posting a lot of really good quality content. If I'm taking me and my 4 kids, I do have 4 kids. If we're going to Disney and like we want to deduct that, and I am a creator, I'm not, but if I were, it could be like posting a whole bunch of stuff before the trip on here, like my favorite things for Amazon with affiliate links of like, hacking hacks and different like gadgets and things like that, like keep my kids entertained on like the road trip down to Disney. I'm filming all throughout Disney and the road trip and everything else all along the way. Hopefully there's affiliate links. There's some like revenue generating some things on it. While I'm at Disney, I'm talking about, our favorite restaurants, how we navigated the different lines, the times of day. Like you're building a whole bunch of content around it is what I'm trying to get at. Like that can then be deductible. If your kids are part of the content or your spouse or significant other is part of it, you can deduct their portion as well. Just make sure you're building a lot of content around this. Meals, that's easy. If you are, spending meals because, I don't know what happened there. If you are, you know, going out to eat and you're talking strategy and content and things like that with your friends or your significant other, deduct the meal. If you're getting Uber Eats or DoorDash because you're working late, you need to work longer, feel free to write that off as well. And then the final one we'll talk about is just auto. Auto, I always say you can definitely write off a portion of your car if you use more than 50% of it for business. But just be very careful. This is like one of those high audit risk areas. Be smart about this. Don't buy a brand new Porsche, slap your logo on it and be like, this is 100% marketing expense. Like you're going to get audited. Just be smart about this one. And even if you don't feel comfortable like taking auto deduction, you can still write off the mileage you drove for your business going to and from Home Depot or like going to like different shoots or whatever. Like you can still write off that mileage. So I'll kind of stop there, right? Because I want to make sure that we have, a good 10 minutes or so. And if we need to go over, we can go over a little bit as well. But want to make sure we hit up the questions that you guys have. And I think Katie, probably the first one you're gonna yell at me for is talking about gifts. So let me talk about gifts real quick, and then Katie, you want to then let me know what other questions we have. So gifts kind of fall into two different categories. The first category are gifts that are like a PR package. You just get something in the mail. A brand sends you a box full of goodies, and they're like, "Hey, we hope you enjoy this product." Wink, wink. They're hoping that you'll use the product, that you'll then do a review on that product, and they get kind of quote unquote free publicity. One of my sister-in-laws is a food creator, and Feastables, Mr. Beast candy bar company sent her a giant box of Feastables a few months ago, and it was like, "Hey, we hope you enjoy these Feastables." Wink, wink. And it's like, she hates Feastables, so she didn't do anything with it. But like, they were hoping, right, that she would post it on her Instagram, on her YouTube, and so on. But so those things are not taxable. You don't owe taxes on that. Free and clear. You're good to go. Nothing to do. Okay. Now, the other one, and this is the one that gets people tripped up, is I'll use a hotel brand. Let's say a hotel comes to you and Hilton says, "Hey, Cody, we would love to gift you 3 nights at this hotel, at our hotel. But in exchange for this, we need you to do A, B, and C. Post this, this, and this type of content, this type of format, in exchange for these 3 nights at our hotel." You say, "Great, that sounds awesome. Let's do it." That is technically considered a barter income. You exchanged goods and services. You didn't exchange money, but you exchanged goods and services. Now, technically, I'm going to use that word, technically, you are supposed to report the fair value of that on your taxes. Then you go down this deep rabbit hole of like, well, what is the fair value, right? So it's like, well, is the fair value what I would have paid for that exact room on that exact weekend? It's like, okay, well, then that's $600, but what if the fair value is the next week when this big event isn't going on? It would have been only $300. Like, it can start to get really complicated. Like, what is the fair value? Don't ask the brands. We've had many of our clients go to the brands and be like, "Hey, can you just like let me know like what the fair value is?" And the brands are like, "Whoa, whoa, whoa, like, hey, like we're not reporting anything, like we're not going to tell you anything. Go talk to your CPA. Like, we're not touching that at all." Because the truth is that 99% of companies are not going to report that on a 1099. because the brand doesn't want to deal with it. I think American Airlines is like the only one I've heard who actually like reports it as income. If you guys have ever received anything, like please put in the chat. But 99% of brands are not going to report that as income on the 1099, which means that it was never reported to the IRS. There was no financial transaction that hit your bank account. The IRS is not going to look through like all of your content and be like, hang on a second, you stayed at this hotel. Was there any agreement? Like they're not going to look at that. So there's no financial record of that exchange happening. And for audit purposes, it's basically impossible to audit that. Now, what you do with that information is completely up to you, but that is kind of how it works in terms of income. One thing I will say, if it's less than like a few $100, do not worry about trying to find the fair value and do not report that. The IRS is not going to give a poo about, you know, a bunch of things that are less than a few $100 that add up to a few $1,000s. Like that's not a big deal. You know, if it's in the thousands of dollars, if it's like a new refrigerator, it's kind of, I'll leave it up to you whether or not you report it or not. Technically, you are supposed to, but like I said, there's no 1099, there's no financial record, so I'll kind of leave it up to you. Okay, Katie, what questions have I missed?
So speaking of food creators, we have one here. Question about buying food and ingredients as a food blogger. Like what?
Yes.
Talk about that.
Yes. Great question. So there's probably two parts to it. I imagine whoever posted that. I imagine there's probably two questions. Oh, Lisa, perfect. There's probably two questions to that. The first part is yes, you can write off all the food you are buying for your content 100% as deductible expense. Do not put it as meals. Meals are only 50% deductible. Put it as like supplies. Okay, so you get 100% of that write-off. Now, the second question that you're probably thinking, maybe not, is okay, well, like I'm buying all these ingredients with my normal groceries. Like, how do I separate out like this is for content, this isn't for content because it's all kind of mixed together? So our food creators take one of two approaches. A pragmatic approach is you bundle it all together and you go through Trader Joe's and you're like, do you know what? I'm going to use a general rule of thumb that 25% of all my food I'm buying is part of my food content creation, even though you might eat it afterwards, right? Like it's part of your content. So 25% everything from the store, I'm going to deduct as business. The rest I'm putting as personal. Okay, that's the pragmatic. That's what most of our creators do. A minority of our food creators will actually like have two different transactions. Like as you're going through Trader Joe's, they'll be like, okay, this food is going to be for my personal. Then they use their personal card, and then they ring up the second half of their food card. All right, this stuff is for business, and then they use their business card. I think that is a little bit overkill. I think if you just take a percent of your grocery bill, find a good, reasonable amount, I think that's a perfect way to do it. Once again, do not put it under meals, put it under like supplies. Otherwise, you're not going to get the full deduction for it.
Someone also asked about deducting Uber and Lyft fees.
Yeah, absolutely. If you're taking Uber or Lyft to go to different shoots, different locations, different events or whatever, absolutely deduct those. Absolutely.
And then back to meals as well. Can you expense a meal that you don't have a receipt for, but you have the credit card transaction?
Yes. So that's actually a bigger question. Thank you, Chris, for doing that. It's a bigger question about receipts. Like, do I have to keep this whole pile of receipts? And the answer is mostly no. You don't need to keep those receipts. If you're going to a place like Chick-fil-A, I clearly have like a Chick-fil-A addiction. If you go to a place like Chick-fil-A and it shows up on your credit card and you are getting audited, which I can talk about audits in a second. They're not nearly as bad as most people take them out to be. The very, very, very unlikely chance that you get audited, if they see Chick-fil-A, they know it's for Chick-fil-A. It's a meal. Like you can't get anything else at Chick-fil-A. So like you don't need to keep that receipt. Most like Amazon, like all of those receipts are digital. You have them online, or you get email confirmation with receipt. You don't need to keep like keep them in your inbox, you know, tucked away. The only time we say like to actually take a picture of a receipt, save it, is let's say you go to a place like Best Buy, you buy a new camera, or a new computer. There's lots of things you get at Best Buy. It was like $2,500, $3,000. It's a really big expense. Take a picture of that, save it. But beyond that, like if it's less than a few $100, don't worry about keeping the receipts, especially if you have a digital receipt or if it's at a restaurant. It's like very clear. You know, if it's a Delta flight, like you know that's airfare, right? Like you don't necessarily need a receipt. So you don't necessarily like the IRS. It's not like the olden days, like where you needed receipts because like there's no bank transaction to back it up. So that's a long-winded answer to answer you, Chris, but that's kind of like the thoughts on receipts.
Last question that I got in regards to deductions was about services like facials or lasers for someone that does skincare and beauty related content. And I know that also if you want to go ahead and answer the Botox one, that's kind of similar. But
Yeah. Yep. So yeah, facials can definitely be deductible. I said earlier that like everything in the tax code for the most part is very gray. Nothing's black and white. One part of the tax code that is very, very, very black and white is cosmetic surgery or plastic surgery. Plastic surgery or cosmetic surgery is 100% not deductible. There's case law against it. Like it is not deductible. Botox is considered cosmetic surgery because you're puncturing the skin. I know it's like not true surgery, but like for IRS purposes, they consider it surgery. So Botox would not be deductible, unfortunately, in that case. Someone put, even if it's medically necessary, if it's medically necessary, that's a whole separate type of thing. Medical expenses can potentially be deductible on your personal tax return, but not as a business expense. If it's medically necessary, and you do spend thousands of dollars on a medical procedure, that can potentially be deductible on your personal tax return as an itemized deduction, but that's kind of a separate thing.
And we're all caught up on questions. If anyone does have any specifics that you don't feel comfortable putting in chat and you do want us to address, you can book a free one-on-one consultation with us. We're happy to answer your questions directly and have a more thorough conversation about, you know, what you need answered personally. Or you can just email hey@cookiefinance.co. That also goes directly to us. I'm happy to give you any more tailored advice that you want.
Yeah, my final thing, I know we're a few minutes past, but my final thing is make sure you're taking those deductions. A lot of people are really, really scared of getting audited. I would say the likelihood that you get audited, like these are numbers reported by the IRS, about 1 or less than 1% of all people actually get audited each year by the IRS. Those are numbers published by the IRS. Those 1%, it's like, oh yeah, like I get why you're audited. Like, it's very, very obvious, like big red flags. If you are playing things exactly how we talked about today, the chance of you getting audited is so incredibly low. So don't be scared to take deductions because there's no need to like overpay just for like a very small chance of getting audited. And even if you were audited, those things are most likely going to be okay to be deducted anyway. So that would be kind of like my final piece of advice I'd throw out there. But yeah, please book a time with us if you want like just one-on-one consultation. We're not going to like push you to signing up for our services, anything like that. Like we really do just enjoy talking with creators, getting to know them, answering your questions for that peace of mind. So Stephanie said that she was audited after an accountant did my taxes. Yeah, sometimes accountants can go a little bit too far. So, but everything we talked about today, none of that is too far. Like it is very reasonable. But yeah, we can kind of talk about that later. But yeah, that's all I have. Cody, I'll kind of pass it back over to you.
Yeah, thank you so much, Planoly.
Yeah, thank you guys. This was so interesting. I did not know how many things you could write off. I need to start posting more videos so I can get some write off my facials. What am I doing? No, great info, especially the stuff about the quarterly taxes and having to pay penalties. I think a lot of people just are not aware of that. So appreciate you bringing that to light. Like they said earlier, we're going to send out an email with the webinar recording and with all of these great resources, the link to book their one-on-one. We have a tax deduction worksheet. I think they included some other worksheets. So we'll get all those links together and we'll send out a recap email. But thank you again to Cookie Finance. This was so amazing. And we just like cannot recommend them enough if you're a creator. So thank you guys so much.
Thanks, Cody. Appreciate it.
Thank you.
All right.
Have a good rest of your day.
Bye, everyone.
Bye.
Bye.